All right, the market started this week off 3 days of really small gains yesterday and Monday, and then a small loss today, very low ranges. But an interesting pattern is developing inside of these small moves, specifically for the S&P 500. It hasn't been so small in other areas of the equity market, and surprisingly not getting the outperformance in some areas that we have heard so much about over the last few weeks or so. And then we're also seeing some interesting moves in some other asset classes that are associated with the risk appetite trade, where we might be seeing some risk aversion. So I'm going to break that down as well. That could suggest, as well as some other technical indicators, the length of this current intermediate trend that we've been on. It's been a nice little bounce back up. Last, I think, Thursday, we had the nice little gap up to the upside. The problem is we haven't extended away from it, or actually more likely to fill in that gap than not. So I'll show you all that, what's driving, which sectors are doing well. Again, kind of an odd couple that were leading the markets here today. We'll break that down and break it down to what's been doing well over the past few days or so. And then we'll look at our trade idea within the kind of in the technology space, more financial space. But definitely a type of bellwether stock for the consumer and the economy. We'll talk about how to trade a significant patterns developing on that stock in particular. So let's go ahead and get started. Today is Wednesday, September 25th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. Join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live videos where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We also put on today's trade idea already before the market closed. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It takes you to this tab. Click that like button again right here. That helps us get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicators. You can see we had small down day today, but nothing too major. Very small range. That's been the case all week, right? Every day has been very small range. A couple up days, a little small down day. The near-term line has stayed around the upper reversal zone. We got above it yesterday by a decent amount. But you can see we didn't stay there for very long. So not really the most bullish near-term peak here. The momentum line is kind of fluctuating around the midpoint of the chart. So that's not surprising considering, again, we're not really going anywhere. But, the upward bias that we've had has kept the intermediate line all the way up to the 96th percentile, higher than any level we got over here. We got the 91st percentile. On this move over here, we were at the 98th. So a pretty strong move. We are below that 2.5% mark. You like to be up above that 2.5% mark when you're trending higher on these bullish moves. You can see being around it. Obviously, the 5% mark is kind of a limit to the upside, but we haven't really reached that at all in the last few. Usually we get that when we're just coming off of a major low point, and we were pretty decently below. We were 5% below the low point there in August. But we didn't rebound nearly to the same extent like we did last October, last October, a year ago. Market sentiment is now rising, so the intermediate line has been strong enough that the market sentiment's rising here. If you take a look at the NASDAQ 100, it looks very similar, very strong intermediate posture. The near-term line is not very bullish, but it's above 80 at least. It's not very strongly above 80, and we'll see if it stays above there for more than just a day. Again, the momentum line was higher than the near-term line on that first day that the near-term line came out of bearish territory. But it didn't get above 80, and so far, really, the near-term line really hasn't either, except, again, a little bit today. The Dow Jones is a little bit more bullish, had been a little bit more bullish. It's turned down more today. As you can see, the momentum line down into bearish oversold territory. The near-term line down below the chart's midpoint. Again, that right there is a bullish intermediate confirmation signal. The last one that we had was right here, and we bounced off of that one for a day, and then a few more days slowly higher. So again, this would be the same signal. This would be a bullish signal that we technically can bounce up off of and continue on the bullish move up to the upside. If you take a look at your Russell 2000, again, here's the other problem that we've been having. The Russell's down more than 1% today. Is the Russell over the past 4 days has been down quite a bit since peaking on the 19th. And remember how the Russell was supposed to be like, the best performer? Remember we talked about that long upper shadow on that chart and how the high point of that long upper shadow ends up being a resistance level? Well, so far that's played out, and as of right now, we are closing pretty much just a smidgen below the low point of that day. So the low of the high day, if you want to call it that. So it's just barely, but it is a second day in the last 4 that the momentum line is down to extreme lows, and the near-term line is down also into the reversal zone. Not by much, but it is down into the reversal zone. So technically this would be a bullish intermediate confirmation signal too, similar to what we saw back here on this day and then again right here. But again, with how extreme it is and the near-term line in the reversal zone, it's not the best odds for that one to play out, like what we saw on the other indicators, especially the Dow Jones Industrial Average. So a lot more significant, and we will take a look more at that here in just a minute when we break down the price action today. Let's take a look at the weekly chart again. Strong, a higher close. We did get a higher high. We're not closing above the high, but we have a higher high and a higher close. Hakunashi close. The size of the candle is not very big, as you can see, but at least it is above its moving average, and the PPO is still rising. So good signs there so far on that weekly chart. Obviously, you have 3 green arrows across the board, right? We still, even with the weakness in the Dow and the Russell, they still both have 3 green arrows. Now, they might not have that tomorrow, depending upon if we bounce up, how much we bounce up. But the other 2 clearly and will have, for at least another day or 2, 3 green arrows in the other 2 indexes. Looking at the 2-line versions, you can see we're still above all the moving averages, even with the declining histogram on the S&P 500. Of course, remember, IWM has been down the last 4 days. It is flirting with breaking its 17-day moving average. It is below its 8-day. The MACD, as you can see, close to crossing. The stochastics already has slightly crossed below its moving average. Let's take a look at some of these other oscillators. The DMI, you can see we still can't quite get going on a good bullish move here. We'd really like to get above 30, but at least above 25, and we can't quite get above and stay above 25 on the positive indicator, even though the negative is well below 20. If you take a look at the RSI and the CCI, again, they are not quite up to bullish levels. We didn't really get bullish levels there either. On the CCI, the RSI is above 60, so that is a positive sign that the RSI at least is at bullish levels there, and we can make this go all the way to today as well. Same with this one, actually. Keep this going. So at least we're still on a bullish move. A little bit of a drop below 50 there, but we didn't get to bear, so we didn't ever drop below 40. So that's why we didn't turn the box red, and we are back up above 60. So we're still okay when it comes to those oscillators. If you look at the Ichimoku cloud, again, we are at intermediate trend strength, well above the cloud, as we are now not just above the pink, but back above the green. So that's a good sign for the S&P 500 as well. The rate of change is still positive, but though it's getting smaller as we get closer to this peak here. The green line is above the blue line, and we're above both. So we're not bad on the S&P. The Russell 2000 is a little different. We are below the green line, and we don't have even a weak bullish trend anymore on the Russell 2000 down there. Finally, if you take a look at the Bollinger Bands and the Keltner channels, again, we are flirting with the upper quartile of the bandwidth. That's actually increasing. The bandwidth outside the Keltner channels, the momentum is increasing to the upside, green dots. It's a good sign we're not above the Keltner channel, so that's a little limiting in the strength of this trend, but at least we are have some bullish momentum, and the bands are outside, and we are in the upper quartile. So that's at least a positive development there. Let's take a look at the intraday chart. You can see we did not get a new high again, so the Arun indicator is weakening there. Again, when the green line gets below 70 and the red line gets to 0, that's when you look for a break up to 100 on the red lines. We don't have that yet. We are a lot closer to the 4-week high point than we are the low point, so we're still okay. Though we still have some of that gap to fill in. We've pretty much filled in the last couple of days this gap from last week, last Friday. We haven't quite finished filling in this gap from last Thursday yet, and I expect that we will, since we've already filled in some of it. Again, looking at IWM, we also have not gotten a new high in a while. It's like the green line, but the problem here is, again, we might end up having another one touch, which is not necessarily the best sign. We did get a lower high and a lower low. We closed below yesterday's low, and we're flirting with last week's low point now, which would be a kind of more of a longer term bearish sign. So that's something to keep an eye on the next couple of days for the Russell 2000. Obviously, your volume or your trading range is really small, under 3 points. The volume is really low as well. So that's really, that trading range, that really small trading range is really bringing down the relative ATR pretty quickly. Remember, getting below 1 is the key, because that really entrenches us on a nice solid trending move here for a while, and we're getting there. The volume, again, has bounced up, so it also has opened up some room for volume to fall down. So that would be, as both of those fall, that would be a good bullish sign for the markets. Finally, looking at the VIX. The VIX still has not crossed below 15, but it's really close. It continues to move in that direction, as we are clearly below the 85% mark, which, remember, this year is the low point. Traditionally, the 80% mark is the extreme, but this year, over the past year or so, the 85% mark has been the extreme. But the nice thing going on here too is that the VVIX is dropping, right? If it can get back below, to these levels that we've been at for most of this year, getting below 90 and below 80 especially, that's a very good sign. At least we're below 100, and that's again, getting below 100 is a sign that volatility itself is going to continue to fall. So I like that we've at least dropped below 100 and we've moved down towards 90. Very good sign for the markets. All right, now let's break down what's driving this price action. So let me bring up the asset comparison chart. And remember, I told you, let's look at today first, and we'll look at the last 4 days that the Russell 2000, which is supposed to be the big winner, right? The big broadening trade, how it's been doing. But today alone, you can see it really was the worst performer, outpacing these international equities. EEM had done so well yesterday after the China news. It had rebounded, but is back down because of pretty significant strength in the dollar. Also, pretty significant increase in yields despite a drop in commodities today. And you can see what gold is doing. Let's go back to the last 4 days of weakness that we've had in, so 1, 2, 3, 4, that we've had in the Russell 2000. As you can see, over the 4-day period, we're down 3%. The S&P is actually down 2, though it's relatively flat. The Qs are up over this 4-day period. You can see bond yields are having an impact there, as TLT is the second worst performing asset class. Gold is up. Emerging markets, as I mentioned, had a really good day yesterday. Had a pretty decent day on Monday too, but especially yesterday with the China news coming out. And you can see gold benefiting despite strength today in the dollar. And you can see that's kind of a unique day that gold continues to move higher. If I were to take a look at gold here, not just on an absolute basis, but let's take a look at gold relative to equities, right? Because it's always if you're gonna invest in gold, you have to not invest in something else. Here's gold relative to the S&P. You can see when it's outperforming, it's typically bearish for equities. Now the correlation is less negative than it has been. But typically when we're above, in this case, above the 200-day moving average, let me zoom out so we can see some context here. When you're above the moving average like that, these long-term moving averages, like we were in 2022, that's actually a pretty bullish sign. Here's a couple of bearish pullback periods for equities, but here we are again, above all these moving averages and trending higher. The long-term PPO is also positive, which generally happens during correction periods. But it's, again, we were positive earlier this year as well when we had our pullback. And so we'll see if this turns into something more or a sign. As you can see, that's really typically pretty negatively correlated with the markets. Is this a sign, this outperformance of gold, a sign of risk aversion rather than risk appetite? The other big move that you saw today was the move in the dollar index, right? And then yields we'll take a look at in a second. But there's your dollar index after a big drop yesterday on that China news. Big rebound today. Again, not a trend-changing rebound, so as big of a move as that was, it hasn't still altered this downward decline that the dollar's had. And you remember, when the dollar is outpacing, it's not necessarily the greatest sign unless, if you take a look at the currency pair here, and let's go to just today alone, September. There we go. We'll go to just today. It's one thing when it's doing well. It can be a good sign when the franc and the yen are also lagging behind everything else. If they're up here too, then a strong dollar is not a good sign. But you can see the euro's up, the pound's up against all these currencies. In fact, the Aussie is actually up against the yen too, and the franc. So when those currencies are outpacing these other safety trades, then this is one of those bullish dollar moves in context of a risk-on trade rather than a risk-off trade. Let's take a look at how bond yields are doing. Let me pull up that chart here. So there's bond yields, again, up about 4.5 basis points today, up to 3.78%, moving higher off of their lows pre-Fed rate cut. So as soon as the Fed cuts rates, the yields have been rising, and that's really done a number on the yield spread, right? The yield spread has been, as the 10-year has been moving up to the upside, as you saw here, 3.79% on the CNBC's chart. The 3-month rate continues to fall, now sitting at 4.62%, so fully pricing in the next rate cut, which is why they expect 100% odds of a rate cut here at their next meeting post the election in November, but a 60% odds that you would actually get another 50 basis point cut. So 100% odds that we'll get one, and a 50% chance that we'll get another. And if you look at December, 60%, sorry, it's about an 80% chance that we'll get another 50 basis point cut by the end of the year, either most likely in November, if not also in December. And again, the odds for cuts all the way through the summer of next year still sit at really high levels. 6.7, so you're looking at about 93.3% odds of 200 basis points of cuts by next June. That's a significant amount. Again, that's a kind of rate cycle that is associated with recessions. I know there's a lot of chatter about what the S&P does when the Fed's cutting rates, when there is a recession versus when the Fed's cutting rates without a recession. Well, when the Fed cut rates, when there's not a recession, they only do it a couple of times, 2, maybe 3 times, and they don't do very much. They do a 25 basis point here, 25 basis point there. When they do cut rates with a recession, they tend to cut rates over an extended period of time. They tend to cut rates by a significant amount. In this case, if 200 basis points would be nearly 40% of the Fed funds rate at its peak. So they cut rates by a significant amount. They cut rates over an extended period of time, and they generally start it with a 50 basis point cut, suggesting that they were late to get started on the cuts. So those are all hallmarks of a cutting cycle that is associated with an economy that is going to, right? Recessions always start way after the Fed, or not way after, but after the fact the Fed starts cutting rates, and after the fact that the 10-year yield, the yield spread, turns positive, right? That's usually by the time the recession starts, this yield spread's up to about 50 basis points or closer to 100. So we're still only at 23 basis points, but you can see it's steepening, and it's steepening above zero, and that's a sign. That's not necessarily the most bullish sign. That has been relatively bearish in the past when we've had a move up towards 200 basis points. If we can stop short, that'd be great. But that hasn't been the case. The other big move today is the breadth really dropped off like a rock. So you still have a lot of stocks up above their 50-day, 200-day moving average. You'll see here in a second. But the McClellan oscillator has nearly turned negative, which means most likely tomorrow, again, barring a big update, and especially a big update with breadth tomorrow, most likely that's going to turn negative tomorrow. Remember, we are already above 1,000, and when you get above 1,000, generally you can see like right there, you can see the summation index peaked there. Here, the summation index peaked. Over here, the summation index peaked. Over here, it peaked and went negative. So, and here's another instance where we went negative. So, pretty good chance that the summation index will go negative, right? Because this is a pretty high level, and it's hard to really extend away from that level with a positive oscillator. Anytime that oscillator is negative, considering that we have a pretty established 50-day return that's positive, 3% down there at the bottom, that'll probably be positive for a while, then that opens us up to a Hindenburg-Omen, which remember we had 5 days in a row of a Hindenburg-Omen. Well, that if the new lows start to ramp up, so you can see the new highs. Let's see, today's new highs ended up being, let's see, what, 207. So it's not quite at 285, but still 207 is still above, or it's a little bit below that average actually. It's right here, so it's going to actually be down here when it gets updated. 207, still below that average, which is not bullish. But it's still relatively high. It has to be above 72, which is way down here, for it to be a Hindenburg Omen. But the other factor is the new lows have to also be above 72, and they're still pretty low, right? And if you take a look at the number of stocks above the 50-day average, that's still high above its average, closer to 400 than not. The number of stocks above the 200-day moving average, also high, closer to 400 than not, also above its moving average. This ratio has not turned back, well, actually has turned barely back above 1, right? Getting above 1, and especially getting back above that average, would be a bearish sign for as you can see the average now during this entire rally coming off of the pullback that we had earlier this year when this peaked. The average has been declining. Did not get back below 1, just like this one didn't over here either. Whereas these other two did, right? We were bullish enough that it did get below 1. This one has not gotten below 1, and once that ratio gets above that average, again, a sign that breadth is deteriorating, right? That we're not getting good breadth. But you can see we're still relatively positive on the breadth, but it is deteriorating. The skew, this is it hasn't been updated yet, but the skew today is at 162.41. So when this chart gets updated, that will be the 5th day in a row that the skew has been above 160. 5 days in a row. Last time, and the only other time in the history of this index that we had 5 days in a row was the last 5 days of June, last 5 trading sessions of June. We were above 60, and we were above 150 for 8 weeks, 2 months. We were straight above 150 over there. So the market is, like it was in 2021, the market's pricing in a bigger than 1 standard deviation move. Has been for quite a while here. As you can see, the skew has been extended for a while. Just for some context on just how extended that skew is, again, you can see just how high this level is, right? 150 is an extreme number. Getting above 150 is an extreme. So we've been above 150. We've been above 160, which is even more extreme. Again, like I said, for 5 days in a row. That means a lot of people are worried about not just downside moves, but outsized downside moves, more than 1 standard deviation. You can see the skew is also, the momentum of the skew is pretty high right now to the upside, which also suggests that it will shift. And if the skew does shift back down again when it gets below its average, that tends, and the average is higher, since 2021, then that's also a sign that things are deteriorating from a sentiment standpoint, right? From a sentiment standpoint there. So interesting breadth signals that we're getting. Again, I showed you the number of stocks up above. The money flow has remained positive, so that's actually a pretty good sign. Though you can saw the volumes have been relatively light here lately. There's your money flow. It is back to an extreme. It tends to not stay at extremes for very long, right? That ends up being kind of a limiting factor. It doesn't mean we have to go down. We can converge for a while. Remember, convergence means we still go up, but the MACD crosses below its moving average. We can stay above the 17-day during that period. Once we break the 17-day, especially technology. If technology, as you can see, we've been so bullish on technology, but if it continues to lose momentum here and is unable to get up above this 50-day average, and we roll over and hit resistance here, we get back below the 17-day, then that's going to be an issue. Here's XLK. Here's what that chart looks like. Below the 200-day, flirting with the 50. If we can break above this, great. But you can see this is negative, which is typical again of corrections when this goes negative. The PPO, when we get into a death cross environment, XLK is not outperforming the market, above its long-term averages. So those are signs that, as I mentioned to you before, as well as the clusters that we have on the market forecast, as on the longer term charts, we had a cluster last week on the weekly chart, and then we've had a cluster last month, and we're looking to get a unique double cluster, not only a double cluster which we've never had before on the S&P, but also with a couple of dots associated with that as well. So needless to say, we are very mature in the bullish move that we're on. In fact, I was looking at this today in class. The zigzag, if you were to count, if you just go from correction lows here, from one correction low to the next peak, we are about a 60% run over a 2-year period since the last correction low point, right? Obviously that pales in comparison to coming off the COVID low, but it doesn't pale in comparison to, like, this was a normal 2-year stretch of about 60% going into the fourth quarter of 2018 before we had that correction there. So it looks like we're kind of in a similar mode here. And obviously the exact same number probably won't work out to be exactly the same, but we're in the ballpark, right? We're a lot closer right now to a pre-correction peak than we are a new correction low point. All right, let's take a look at the sector comparison chart before we look at our trade idea of the day. And just look at today alone. You can see that utilities and real estate are your best performers over the last 3 months. Let's look at today, September 25th, the last 5 minutes. And technology is still an outperformer, right? So it's still okay, even if it's losing momentum. Utilities is your best performer. Again, not a risk on situation there. Staples also a pretty decent performer. Energy and healthcare down there at the bottom, some of your worst performers. Again, over the last 4 days, since XL small cap index have been underperforming, you can see utilities is killing it. Discretionary doing pretty well in technology, communication services as well, materials benefiting since the China news on yesterday. But you can see at the bottom, financials getting hammered, healthcare getting hammered, as well as energy getting hammered. So those are all three sectors that are really struggling. And healthcare traditionally has been kind of a safety trade. Financials has been more cyclical. And then energy has been kind of cyclical too, but really struggling over the last couple of days, as I mentioned. Commodities are pulling back pretty hard. Here's what energy looks like here on this chart. Breaking below its 17-day, has been lagging for some time, even if you've been gaining some relative strength and momentum. It's still so deep in that relative strength, it's hard to really take off there to the upside. All right, with the weakness in technology and financials, that takes us to our trade idea of the day, which is actually in Visa, which just kind of fits both categories there. If you take a look at Visa, obviously embroiled in some legal issues. You can see it's really dropped the stock. It got a bull tag yesterday. It built on that bull tag today with a move to a much lower low. We're below the 2.5% mark there. Short-term sentiment's extremely bearish, both the momentum and the near-term line down at extremely low levels. The intermediate line is close to falling out of, probably one more day away from falling out of bullish territory and crossing below its market sentiment line, maybe a day or two away from that happening. So a big, strong move to the downside. You can see a big transition weekly candle on its chart, on its weekly chart, eventually. There we go. So let's pull up Visa. Sorry, let me see if I can get this chart up here. There we go. So a transition candle, that's obviously a big bearish candle, right? So that tends to lead to a bearish mode going forward. You can see the PPO is positive, but now starting to roll over. The size of the candle has gone well below its moving average. Red arrow as we've fallen below the 10-week exponential moving average. If you take a look at the 3 green arrow charts for Visa, you can see you are below the 200. We've broken below all the averages in the last 2 days. Today you broke below the 200 and the 50, below the point of control yesterday, as well as the 30-day. The MACD is crossed below 0. The stochastics is crossed into bearish territory. Pretty decent volume, as you can see down there at the bottom. If you take a look at its DMI, the negative indicator is really taking. The ADX is still pretty high. It's above 25. So you can see the ADX is still above 25, but the negative indicator has gone up to 35. The positive still hasn't even dropped below 20 yet. So it kind of goes to show what we might still be in the initial stages of weakness on this stock. If you look at this RSI and the CCI, they are both at bearish levels, below minus 200, below 40 on the RSI. Looking at the Ichimoku cloud, we're still above the cloud. The rate of change still positive, though we lost our bullish trend because we are clearly below the blue line there. So that's a negative sign. The bandwidth, as strong as it's been, it's a pretty high bandwidth still, but we are now in the lowest quartile of that pretty strong bandwidth. And we are below, or at least flirting with, the lower Keltner channel already, even though the momentum is still positive and our dots are green and probably will stay green. But we've already we've had a big significant change from being above the Keltner channel to being below it in just a matter of a few days. A big move in the wrong direction for Visa. So what I decided to do there was say, okay, well, let's take a look at selling the 260 and buying the 265. So relatively bearish move. Low 20 deltas there, so it's pretty aggressive. Almost a 4-to-1 reward to risk ratio, so low risk trade when you consider the reward we're shooting for in a short amount of time. And there's a little bit of built-in flexibility. Despite the big reward, I have it doesn't have to move immediately today or tomorrow. So I've got a little bit of flexibility for timing on this in case it doesn't work out necessarily immediately. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.